You are approved and house shopping, nothing to worry about, right? Wrong. In this video, we're gonna talk about 6 things that can come up after you've been approved and what you can do so this doesn't happen to you. Number 6, undisclosed debt. These are payments that weren't on the initial application. Some people buy cars just before closing. Others have child support or alimony that they didn't think to bring up because it comes out of their check automatically. Or before closing, you go on a really epic vacation and open up a new credit card and pay for it all. Sounds fun, but it could cost you your loan approval. Number 5, income discrepancies. This is when the calculated qualifying income is different than what was on the initial application. Sometimes a commission employee may say what they made last month, but last year was much lower. Great job on the increase, but we have to use a 2-year history. A self-employed person may say how much they took home last year, but forget to include all the expenses that were paid out of the business. In this case, the tax returns show a much lower net profit than what they took home. Last one, and this one really intrigues me, but it does come up more often than you would think. Someone quits their job just before closing. Yes, this happens. Don't do this. Number 4, credit. Credit is typically reviewed before an approval is issued, but there are a couple things that can come up after. During the process, your name will be checked for judgments. These typically don't show up on a credit report anymore, and it could be for old debt that you may have forgotten about. If one does come up under your name, it could be an issue. Now, in some cases, there can be someone with a similar name. It's amazing how many John Andersons there are in a big city. Anyways, if this happens to you, it's pretty simple to verify that it isn't you. There can also be collections that pop up for old debt. Number 3, lender mistakes. Yes, it happens. It's one of those things isn't really talked about, and if it happens to you, it's likely that you won't even know this was the case. This one right here is the very reason I created this channel and do these videos. I wanted you guys to know exactly what's possible and what to do, and I've noticed these types of things tend to happen to loan officers that have been in the business less than 5 years. There are many guidelines to know and understand, and all it takes is missing one thing to cause an issue. To avoid this, make sure you get an underwriting approval rather than a pre-approval. Let me repeat, get an underwriting approval rather than a pre-approval. It's an approval issued by an underwriter rather than a loan officer. It's in writing and lists everything you need to go to closing. This can take care of most of the things that we've talked about so far in this video. Do it! Okay, rant's over. Number 2, money shortage. Sometimes people send in a bank statement and it has $10,000 in it, and just before closing, they now have $2,000. Do your best to maintain the balance that you have during this process. If something comes up, be sure to communicate it with your lender as soon as possible. Many times the issue can be solved. And topping the list at number 1 is property issues. This is the most common thing that can throw a wrench in a purchase. Sometimes the property might not appraise for what you're paying for it, or there may be problems within the property that were discovered in the appraisal or a home inspection, and you, as the buyer, decide you'd rather not buy this property. If you make sure to disclose everything to your lender and get an underwriting approval up front, you can avoid many of these problems. If you found this video helpful, please be sure to give it a thumbs up. If you have any particular questions you'd like to have answered, please be sure to leave it in the comments for a future video. See you in the next one.